Institutions like us because of our risk controls. They're adults. They know nothing is guaranteed. Money goes up. But when you look at how we use third party, I touch no money. I couldn't touch money if I tried. We use a third-party fund administrator called Industry FinTech out of Miami. They do business administration from all the way from auditing streams of their wrapper clients of Spotify to businesses to funds to institutions. The way that they are custodians of capital is at the highest order of integrity. And then having their internal accounting mechanisms, having ways to really make sure that for example, the financial analyses that we do on our deals is done by a third party. Meaning, having audited financials, GAAP audited financials at the corporate levels for the past almost a decade, having an audited track record and having institutional risk controls, that's why they give us money. Because they know that what they write a check for is what they thought they were writing a check for. The numbers that they're looking at, they know that we have not drank our own Kool-Aid, that a third party that's paid a flat rate, give or take what it doesn't matter what the number says, and don't have any financial interest in anything we're doing, they have a higher degree of certainty that they can be confident in what we're doing. They're a complete fucking pain in the ass. And I tell them to their, they know they are. They know they are. They have board members that are deliberately obtuse. They have antiquated investment theses. They have consultants, and look, there's some, just like anything, there's amazingly brilliant, incredible ones. And I could give you a list of them that we've worked with but they're people also, they're people, they're grumpy, and some of them want to do stuff. Some look it through an old lens. Some are too old. Some are too young. And it's like herding cattle. So it just takes longer. So a lot of times, even when they're saying yes, the yes takes 6 fucking months and the deal's gone. So, oh no, we're good. We're good. I'm like, no, I'm not good. We missed the deal. And that's happened many times. We've been approved on huge, huge, huge platforms. We had a $52 million deal just outside of Kyle, approved by 2 of the biggest pension funds in the world on a diligence basis. They couldn't get out of their own way. And trust me, they were upset about it. And we ended up missing the deal. They ended up missing the deal. The consultant is a very dear friend of mine. And we both begrudgingly kind of like, fuck, like, what else can we do? But the speed of which a battleship moves, so to speak, is not the speed that an individual investor. So you trade the speed at which something's going for the size of the check. So our hope in quelling this is that we have enough of the smaller, agile checks that can help us lock in the deals, get them in the right place, and then by the time for the larger institutions or bring them into larger funds that we can draw down at the time that we need them. So it's very much a balancing act of pairing the right deals with the right capital. Deals come to us now. I mean, we're at a place now where I've become, admittedly a pretty public figure in this space. People bring us deals. The brokers are our friends. The heads of the big shops are our friends. The heads of the big banks are our friends. That we are at not a shortage for deals by any stretch of the imagination. And then once we go in, I do a high-level curation, and then we have an acquisitions team, financial analysis team, internal and external, that work together. And a lot of times, they don't entirely agree, but in that dialogue, we tend to find better answers. But I'm very involved in overseeing the acquisitions at a high level, certainly from a market standpoint, certainly from a community standpoint. But then I let people much smarter than me handle the details. And a lot of times, due diligence, depending on the profundity of the deal, we brought in third-party due diligence companies to have a third-tier approach to looking at these deals. So it really is on a deal-by-deal basis. In Austin, we understand the market cold. We're able to move a little bit quicker, but we have a project in downtown Phoenix in the Opportunity Zone that we worked with some third-party brokers on. We brought in some subject matter experts from an architecture standpoint, from a GC standpoint, from structural capital partner standpoint, to really get a good confluence of information, because we weren't as familiar with the market. It turned out to be fantastic. We're going vertical in the next 4 months, but it was several years in the making to get there. But as I keep saying, it's about finding the right answer. And Diligence is something that we are not penny smart, pound foolish on. It's our money, so you don't have to, trust us per se that we're doing right by your money. You can trust that I'm doing right by my money. That's the best part for individual investors, and why I think our value proposition is so much greater than other folks in our space, whether using the word syndicator or whatever these stupid words that are used are, is that you're not just trusting us, you're not just trusting our third-party admin, you're riding on the coattails of institutional due diligence with the smartest financial advisors on the planet, finding every reason not to do the damn deal. And as I say over and over again, that does not guarantee you're going to make money. I hate that word because, as I said, you go hit by a bus, but it does increase the probability exponentially that you're in a product that has high conviction.